Hi everyone, Assalamualaikum and good morning. My name is Muhammad Hakim bin Jibris and I'm from PA 24240. On this morning, I will represent or discuss about Islamic finance, which is by Al-Murabahah versus conventional loan. Firstly, I will discuss about the value of propositions of Islamic finance. Islamic finance is a financial system that operates according to Islamic law and is therefore Sharia compliant. Just like conventional financial systems, Islamic finance features banks, capital markets, fund managers, investment firms, and insurance companies. However, these entities are governed both by Islamic law and the finance industry rules and regulations that apply to their conventional counterparts. Islamic banking or Islamic finance is banking or financing activity that complies with Sharia and its practical application through the development of Islamic economy. Although the Islamic finance industry itself is quite young, Islamic theories of economics have existed for more than a millennium by the mid-12th century. In fact, many Muslim scholars had presented key concepts of Islamic economics that are still relevant today. Moreover, Islamic economy is based on core concepts of balance, which helps ensure that the motive and objective driving the Islamic finance industry are beneficial to society, which is balancing material pursuits and spiritual needs, and balancing individual and social needs. A core concept of Islam is that Allah is the owner of all wealth in the world, and we humans are merely its trustees. Therefore, humans need to manage wealth according to our commands, which promote justice and prohibit certain activities. And at the same time, Muslims have the right to enjoy whatever wealth they acquire and spend it Sharia compliant ways. They don't need to feel shame about being wealthy as long as their behavior aligns with Islam. Next, based on the core concept of Islamic economy, Islamic finance institutions adhere to certain principles that distinguish them from commercial finance, which is prohibiting interest, which is riba, steering clear of uncertainty-based transactions, gara. Next, avoiding gambling, which is paise or kibar, and the last one is avoiding investment in prohibited industries. For your information, under the Islamic finance, there are plenty types of Sharia contracts, such as exchange-based contracts, partnership contracts, charitable contracts, agency contracts, security contracts, and the last one is sapati contracts. And now, in this video, I will discuss about the Bay al-Mudarabah, which falls under the exchange-based contract. So, what is Murabahah contract? Murabahah contract is a type of trust sale contract under Sharia in which the purchaser relies upon the integrity of the seller to acquire the desired Sharia compliant asset at a reasonable cost. Under a Murabahah contract, a bank will purchase a commodity in order to supply it to a customer who is not financially able to make such a purchase directly. The bank sells the commodity to the customer for the cost plus profit, with that profit will being a markup that Both the bank and the customer agree on the upfront. The customer can make a lump sum payment when the commodity is delivered, but usually sets up a deferred payment installment schedule. For example, let's say a manufacturer wants to buy $100,000 worth of wood, but he or she doesn't have enough funds. The manufacturer approaches the bank and signs an agreement to purchase the woods from the bank at cost, which is $100,000 plus profit, maybe 20% of the contract amount or $20,000. The manufacturer then is liable to pay the bank at $120,000 after the bank delivers the good. Both parties know the profits and the cost of the product at the onset. Therefore, there is no financial uncertainty in the transaction. The bank, rather than lending money to a borrower, purchase the commodity from the third party and sell it to the customer for a higher price. So, this financing mechanism has nothing to do with the conventional way of financing. However, there is a few conditions that need to meet in order to make a valid contract. The first condition is the price must be disclosed to the contracting parties. Price is conditions to its validity. It must be disclosed as this is a trust basis contract. Secondly, the markup must be disclosed to the contracting parties. Profit must be agreed by both parties or it is void. Next, the origin price should be fungible properties. Fungible properties such as variables, measurables, and countables. Next, the Murabahah contract should not lead to riba. Not valid for ribawi items such as gold, silver, and etc. And the last one is the initial contract should be valid. Acquired via valid contracts and its requirements in Sharia contracts. If the first contract is not valid, the subsequent contract is also invalid, as Murabahah works in process. Now, I will discuss a little bit about the conventional loan. So, how does the conventional loans work? In conventional loan, the bank lends borrower money with an interest. Bank then earn a profit from the interest charged on the amount borrowed. For instance, when you take out a loan, you will repay the loan amount along with the interest rate and the prescribed rate over a set tenure by installment. The specific rate is based on a margin above the bank's base lending rate, which is BLR. If a borrower makes a late payment or defaults, the bank has the power to charge additional interest to the amount borrowed. The interest accumulated is a way of paying extra fees when you pay late. The interest payable may also be capitalized, which means an interest charge is added to the total amount of interest owed since the last payment of the balance. Now, I will discuss about the differences between Murabahah contract and conventional loan contract. The contract structure Murabahah is a sale contract, while for conventional loan, an interest-based lending agreement and transactions. Next, Murabahah contract is not an interest-bearing loan, while conventional loan is based on loan principal. And the last one, under Murabahah contract, the original cost and the profits are disclosed to the buyer. However, under conventional loan, the amount of payable will only be known at the end of the period. So, in conclusion, every type of contract either in Islamic finance, which is buy al-murabahah or conventional loans, has their own characteristics and benefits, which depends on the personality of characteristic of the parties. Murabahah transaction should be carried out in a prescribed way because it has a slight difference with the interest-based loan procedure and more effective. So that's all from me. Thank you for watching. Assalamualaikum.